Hey guys, and welcome to Road to Forex. As always, my name is Alex, and I'm appreciative that you guys are here with me today. Now, we got a good one for you, because this is part 2 of my price action series, where I'm going to be going over how I would actually hop into trades, FVGs, and everything else in between. Might even come up with a part 3 if I feel like I've missed anything out. Now, usually this is reserved for Patreon members only, but just for this one time, I'm releasing the full extended cut here because I think it can help a lot of you out. And if you do like it, you can obviously click the link in the description and join Patreon yourself for more extended goodies like this. Now, for those of you that are watching on YouTube, if you could please like the video, if you could subscribe, and of course comment, because it really helps me out in the algorithm. But for now, let's head on over to the charts and see what we can find. So currently I'm on the Great British Pound Swiss franc charts, or Great British Pound CHF charts as I like to call them. Now, we have two things that we're looking out for in terms of wicks, right? They were the two things, which are either large wicks or consolidation wicks. That's what we touched on last time, if I can in fact spell. There we go. So if we're looking at these two areas, what I'd like you to do is pause this video and tell me, does it look more like large wicks or does it look like consolidation? Of course, the answer is large wicks. When it comes to consolidation, it's more like an area like this, where it's a tiny little square, but instead we're probably looking for 2, 3, 4, 5 wicks in this area, where the market's not moving. We've got that horizontal, maybe, especially on the half an hour, it might only be 10 candlesticks worth. On the 1 hour, it might only be 5, 6, maybe even 7 candlesticks worth. That's all we're looking for, but we're looking for wicks in a certain direction. Now, obviously, this down here does not look like this area up here, and it most certainly does not look like this area over here, because this one starts to move more horizontally. Is it the best example in the world? No, but you can clearly see that these markets are trending, and then they just come back down. Comes up, and then it comes back down. Not this area here. If you were to find a better area for us to look at, and in fact you can see one through here, where again we just start to move sideways, and again it's a nice little block with 2, 3, 3, maybe even 4 wicks in this area. That's what we're looking for in terms of consolidation. We don't have that. So let's move on and see what we can find through here. Once we know that we have either A, large wicks, or B, consolidation wicks, and it can even be a combination of both for a first and second touch, I can start to draw out our lines. Now, what I've got through here is a line that comes across and it perfectly hits it. Now, why would I draw this line out here? Because remember, we don't know if this line needs to be drawn here, or it needs to be drawn here, or maybe somewhere in between. Who knows? Either we're drawing it where candlesticks are closing or at the top of the wicks. And this second, basically the second touch here, confirmed it for us. Because it comes up and it touches this exact point where these candlesticks are closing and really touching on with their wicks as well. So we know that we've got an area of perfection. Now, if this had stopped somewhere down here, that's not correct, because we'd be having 1 and 2 areas that are above it where these candlesticks were just closing above. That doesn't make sense, because the only one set of candlesticks are closing here, not the vast majority. See, if I put it here, where this wick is basically closed, I have this one bouncing off it in terms of a wick. I've got these ones basically closing on it here, and these ones actually doing the same. So I know I've got that perfection. That makes sense of where to put it here. Again, if I was looking at something down here, would I have put it there? Maybe. Would I tried to chuck it here? Yes, I would have, because I can see that there's a candlestick here, and this one's just poking its head out. Now, obviously, this is not a great example of perfection, because it's not closing high enough. I'd be looking for something like this, for the candlestick to close here. Now, if it closes here, I can basically say, okay, I've got a good area where it's coming up and it's touching this line. I have perfection. Another great example of perfection, if we just quickly zoom out, is something along these lines. we have 2 wicks basically hitting the exact same area. That would be a great place for perfection. And in fact, it comes along here and basically does the same thing. Now, why didn't I look at an area like this? Alex, this is clearly a wick. Alex, this is clearly a wick, and it's a large wick. Here's 3 areas. Why wouldn't I hop into this? Well, of course, what we've talked about multiple times is it needs to come up to an area, and it would need a heavy buy. And then it would need to come down for your second touch and have a heavy buy. And then we'd be waiting for the third thing for the exact same time for it to happen. We don't get that in these smaller areas. What happens over here? Well, we come to here, we sell off. Now we're coming up to here and we're selling off. So I'm assuming that if we come back up to here, we're going to sell off because the market's shown me that it wants to come down. If it doesn't show me like this, we hit here and we didn't really come up. We hit here and we did, but that's only one touch. It's nothing really there. So I'm going to be leaving that one out. So hopefully you understand what I mean by perfection through there. Now, once I get touch 1 and touch 2, remember that I'm probably thinking that there is an order block somewhere in this area through here. And if there's an order block, because there must be, the market comes up, just like that motorway, I can't remember what it's called, a metaphor, I guess, a way of explaining things, where a car, it's shooting up the motorway 100 miles an hour, and it hits this area, and it just goes a full 180, and just goes, nope, I'm going away. There was a lot of buying pressure coming into this area, and something up here made it stop. So, cool. We go away, we go on our journey, and then we motor all the way back up. Look at that buying pressure coming up to this area, and then we just slow down. Hit here, reject off it like we're touching a hot stove. Oh my goodness, that's way too hot. And then we fall down again. So there must be something big here. Now do remember that if we have an order block, it's most likely that just above it, and I'll change the color for this one, we're going to have a liquidity pool where we're coming into and everyone's stop losses are going to be. So if I'm waiting for this next entry, and I will be putting a sell limit order on this line, I am going to be wanting my stop loss to be above this area. So let's go and see how this works out now. So I've skipped the market forward slightly here, and what you can start to see, and now you're getting an understanding for the start of the strategy, is that we have these big run-ups with a lot of volatility in them, a lot of pressure to the upside. It's like we're trying to break through, right? We're hopping in our rocket and we're just trying to go through there. We're hopping in our car and we're going that 100 miles down the highway. Do the same thing here. It's like the market amps up before we get to this area. It's like buy, buy, buy. We need to get into these areas. What happens as we're going towards this area for the third time? That's a lot of buying pressure in the market. That's a bloody big candlestick that we've got there, and we're just jetting towards it. So whilst that happens, you can see that's really pushing. Now we come up, and now we're in the market. So this is quite interesting, because we come up and we do exactly what we did over here. And kind of what we did over here. We've still got that one big wick, and yes, we're closing on these areas here, but now we're doing the same thing. And you can see that we came right up into this area. We'll probably have our stop loss probably actually just get a little bit more over this area, because we can see that the top part is right there. We've got a little tiny wick if I move this up here, so I'm just being cognizant of that and just putting it above it. See, if I draw my line, that dotted line that we can see on the screen, it's just going to be above that wick in case it decides to rally and do exactly that. So it comes straight up to here, and yes, it is true, I already know the outcome of this, so I'm not going to joke around. I already know what was going on, but I would do the same regardless, because we know there's liquidity in this area. We touched it here, we came into it here, we're doing the same thing, because if we want that sell to happen again, we need to take out liquidity to hop those orders into the market to push it back down. And then, of course, what happens from here? We surge down. If we're going for that 1 to 3, which I've talked about before, we go for a 1 to 3, we then hit that and we can start to hop in. So now that we know the outcome of this, I've deleted everything off the screen and we're going to use what we've already touched on, which is the order blocks. So if I type into indicators and I go order block breakers and blocks. I'm going to click on this one this time. What we're going to see is that this entire time there has been an order block in this area, probably from where it started to sell off, and you can literally see that here. So if there's an order block in that area, we know that the most likely thing that's going to happen is when the market comes into it, it's going to want to reject off of it. That's just a natural thing that's going to happen in the market. However, what I would love to have done as well is look for an FVG. In fact, you need to type in fair value gap. And this is by Spaceman BTC. Because if I come in here as well, and I go over here, you can see that just underneath, we've got this big fair value gap here. And guess what's just above the order block? Another fair value gap. So when we were talking about liquidity, we already know there's going to be liquidity because when we come up into these areas and we reject off of them, people are going to be putting their stop losses in regardless up here, but we've also got a fair value gap, which is what? Liquidity in the market. The market wants to come up, the market wants to touch it, the market wants to test it, and what happened when we hopped into the market? It came up, basically touched this area just like it did before, and then it shot right back down. Now, why did it do that? Why didn't it take it out? This is a really interesting thing when you pair order blocks and FVGs together. You know the liquidity is there, so why didn't we come in? Because when there was big selling pressure in this area, you're probably looking at the epicenter of where this massive sell started. Right in this area. So if I were smart money or there was a good amount of orders, I'm probably sitting in this FVG. Now, is that the case all the time? No. But why would the market not want to fill the only FVG that you can see in the area apart from here? Well, maybe there are some orders in this area. Maybe it's from banks. Maybe it's not. Maybe it's just a key psychological level where a load of people have sold or a load of people have, well, it's only a sell, I was going to say buy, but a load of people have sold. So when it comes up to this area, that's where all of those orders are, pushing it back down. And most likely smart money has gotten in there as well. And there is a big amount of orders. So when we come up here and we know there's a load of sells in the market, maybe there's retail traders doubling down. Maybe there is smart money hopping in again. Who knows what's going on there, but we know we've got a load of selling pressure from this area. Therefore, when it sells off again and it creates this order block directly underneath this FVG, suddenly we know, hey, we've got a lot of liquidity here and we have a crap load of orders. Both of these things are going to do what to the market? Really push it straight back down. Let's go and find another example because this didn't happen that long ago. This is the 29th of October and right now we are in, it's not going to actually tell me it, if we go all the way back to the current time zone of what we've got right now, 8th of November. So it's not that far away. Let's go and have a look at another example. So right now we're on the NZDCAD 1 hour chart. And yes, this happened in August, but remember you can trade this on multiple pairs. So although this happened in August and our last pair happened in October, maybe Euro Great British Pound happened a week ago. Maybe AUD-CAD happened yesterday. Who knows? You can trade this on all major and minor pairs. So do be aware of that. I really don't like people that post videos and then say, here's a perfect example from 2020. I was watching one the other day. Yeah, thanks mate, that helps me out a lot. 2020, it's nowhere near what I'm trading right now. So I still want to be as relevant but as open and honest as possible. So let's get into this one. We already know that we've got perfection. Why? Because we've got a large wick here. And it comes up and it hits this top area. We also have a massive wick in this area as well. So we've got number one again, the two large wicks, large wick areas. And we've got perfection. Guess what? We've got an order block in this area. And what's above it? We have our FVGs, our FVG guys. So we know that once it comes up here, and as long as it doesn't poke its head over, which it doesn't, and it gives us that sell-off, we're ready to place our sell limits right at this line here and put our stop loss above, and of course, go for that 1 to 3. Because remember, we're putting our stop loss above the area of liquidity. That's what we're looking for. In fact, if you really wanted to, you could put it here halfway through. I know in the last one, we put it just above the wicks there, but considering that there's an actual gap here, rather than the FVG being completely on top, I know that it's more likely to pick this area, and then we could be in a bit of a bother. So I'm going to put it here, right above this FVG there, and I'm going to be looking for this 1, 2, 3, which is going to be somewhere in this area. We know that we had both the build-ups that we wanted, really strong bullish build, we were going 100 miles an hour on that freeway, and we turn around at massive sell-off. What happens again? Super strong move to the top side, turns around, sells off. So, then we come up to this area. And what happens through here? We come up, come up. Oh, we just missed it. And then we get that sell-off. So what I would do in this case, guys, and this is a really important one because I want to show you one that doesn't work. Look what happens after this. It shoots up and takes our stop loss out. So how would I have protected myself from this? If it doesn't hit our area of perfection, but it's within 5 pips of that perfect line, it's 2.4 for this case, and it goes down and it would have hit our take profit, I consider it close enough that the move has gone and it's disappeared. It's out of there. Now, there are 2 schools of thought on this. Okay, well, if it's 5 pips close enough, Alex, well, why wouldn't you move this down just 5 pips here? Because I want to go for perfection. That is what we want. That is our perfect entry, which means that I can potentially go for even more, or I can have my stop loss, well, my take profit, in an easier position to attain. If I need to bring it down 5 pips, and let's bring it to 16, which is what it would be. Yes, we still definitely would have made it, but now my 1 to 3 is down here. I guess, the difference being, now my 1 to 3 is here. That's what I'm looking for. It is a big difference, and over time, you're not guaranteed these big moves or for them to fall down as far as they are. You want to hop in and out of the market quite quickly. This allows me to do that. Yes, I have to give up on some trades, but if the markets don't want to be perfect, then I don't want to be a part of those markets. And that is why I structure it as I do. So remember with this one, I'm looking for perfection. I'm looking for those wicks. I'm looking for the 180s. That's massive build-ups, big sell-offs, massive build-ups, big sell-offs, and vice versa if you're going for some buys. And I want an order block with an FVG directly above it. If it doesn't have that, then I know there probably aren't enough orders to force that market back down. And that is how I am going to structure this lesson. If you have any questions at all, please comment below. I'd be more than happy to discuss them with you. Of course, there's a lot of things that we could do differently with this strategy as well, and I can refine it and refine it and refine it with different indicators, but those are for my mentorees. I can't give every single thing away here. So with that being said, this is how you can start to look at the markets with this strategy. Now again, it is so much easier for me if I do take everything off the market. And this is what we want to be doing. Eventually getting it to a point where we are naked chart trading. So pure price action. Why? It just makes a whole lot more sense. I don't need to know that there's an order block there because I already know. If it comes up to this area and it falls down, or even once, I know there must be a ton of orders here to stop such buying pressure for it to fall down. And guess what? I can just look over here to my left and go, oh, there's all this uncharted area. And just like the last one, where did this big move really start from? Somewhere in here. So I know that there's an FVG above. There's an order block somewhere in here. There's 2 bits of buying pressure. You can see my stop losses in here just in case it wants to fill this gap. And I've perfectly protected myself. And I can do all of these things without it. Now, what does that do that's really good for me? 1, my screen is not cluttered, so I'm looking at price action as perfectly as humanly possible because there's nothing there. There's nothing that lags. Maybe an indicator messes up. I don't know. Maybe your screen is really small. You're trading on your phone. It's a lot easier when you're just looking at these naked charts. And because my eyes have been trained and I can see them, I do not have to rely on anything that lags. Now again, FVGs and order blocks aren't really going to lag as a whole, but in saying that, if you can remember them, that means you can start to look at the market and understand where things are moving from, what's happening. You start to see these big sells, you start to understand that an order block is there. So if you know there's a big sell-off and it just comes through, and maybe I was looking at it at one point like this, I'm already setting price alert somewhere in this area. So if it comes up and it wants to retest it, I can have a look. So then I'm not missing out on trades, because maybe here I'm not seeing the order block right now. Maybe I am. Of course, if we do put the order block back on, it's going to be there, and you can see that. But I would probably already know that before the order block came up. Let's actually see when it appeared. Comes into another order block area. Where does it say? There. Right before this big sell-off. So hours after, I would have realized this is here. And again, if this did sell off and then comes back up, maybe you miss it. Maybe you don't, but you don't want to take that. So what I'd be suggesting to you is just to use these indicators here to help train your eyes. So when you do come into the markets, hey, I actually understand this stuff without having to rely on it. Now, you could be a technical trader with, well, price action trader your entire life with it. And there are a lot of people that do use indicators for that amount of time. I'm not saying they're worse than me or I'm better than them. I just think if I can see all these things without a reliance on an indicator, then I'm so confident, number one, in my ability to trade, and confidence is so big. If I have full confidence in myself, it probably means I'm not going to stray away from my strategy. So in terms of that, another psychological benefit there. Again, no reliance on an indicator that maybe it's going to lag, maybe it's going to fail, probably not, but hey, I'm here to be safe. And when I actually look at different charts, maybe that move a lot quicker, like 1 minute, 5 minute, where these definitely will lag, I'm in a position where, hey, I'll be able to hop in and out of these markets with full confidence, going, I know that's there because Alex has taught me these things, because if the market moves like this, that's what's going to happen. You understand everything intrinsically. You don't need the markets to explain it to you with some indicators, and that is going to benefit you massively in the long run. Anyway, guys, that is it from me. I hope you've enjoyed it. Again, like, comment, subscribe, share this stuff. I would absolutely love that. Until then, guys, you have a wonderful day, and I'll see you in the next one. Bye.